Good morning and welcome to the Invicta Holdings Limited final results webinar and presentation for the year ended 31 March 2025. The management team will be taking you through the presentation and you will have the opportunity to post your questions by using the question function on your screen. I will post your questions to the panelists after the presentation's conclusion. I now hand you over to Stephen Joffe.
Welcome to all of you and thank you for joining us. I am Stephen Joffe, the Chief Executive Officer of Invicta, and I'm joined by our CFO, Natalie Raj Mohammed. Craig Barnard is also available as part of our panel to answer any questions you may have. During this presentation, in respect of any commentary or views we may portray, and to the extent we analyse information or make forward-looking statements, please have regards to our disclaimer. Today's presentation will cover our group and segmental results for the year ended 31 March 2025. We will also attempt to cover key developments for the year, as well as looking forward to the prospects and strategies of the group. Invicta distributes world-leading capital and earth-moving equipment, industrial, automotive, and agricultural parts, often exclusively, which we try to ensure are always available and are overlaid with a technical and service solution. We thus differentiate ourselves by adding value through our distribution chain, product availability, and by providing technical support. Technical support helps prevent disintermediation and is a key part of our strategy to add value to our customers. Invicta is pleased to present a strong set of results for the year, reflecting the robust and consistent nature of our core operations. Throughout the year, we worked hard on streamlining our operations and have made great strides in redeeming all the outstanding preference shares in the year, as well as disposing of the main distribution warehouse in the Key and Ann operations in Singapore. These achievements affirm our ability to execute on our strategy and capitalise on opportunities across our core markets. The strength of our operational model and the strategic initiatives have allowed us to maintain stability and growth in the businesses in the face of tough operating environments. We remain confident in the strength of our businesses and the long-term value we aim to deliver to shareholders. We continue to focus on executing our strategy, driving operational efficiency, and positioning ourselves for sustainable growth. We believe that our strategy of investing offshore in our markets will, over the long term, deliver the return we endeavour to obtain for our shareholders. Throughout the year, many central banks have continued cutting the interest rates to stimulate activity. We welcome the 3 interest rate reductions implemented by the South African Reserve Bank during the financial year, and we hope that the cuts will continue as interest rates remain high. Throughout the year, we experienced volatility in currencies and supply chain challenges, including shipping and logistics, as well as delays at the port. Eskom achieved a period of continuous power supply for over 300 consecutive days from the 26th of March 2024 through late January 2025. This enabled our customers to conduct business uninterrupted for an extended period for the first time in many years, and we hope this will continue throughout the winter this year. In the lead-up to the South African elections, and for a period thereafter, until the establishment of the GNU, we experienced reservation from customers in placing orders across the board. In certain sectors, this has created a glut in the market, which resulted in pricing pressure, as many suppliers became overstocked. After the market digested the outcome of the elections, we saw the local markets experiencing improved activity levels, which has subsequently remained relatively stable. The industrial sector in South Africa remains a challenging environment in which to operate, with government policy doing little to create growth in the sector. Notable achievements for the year, notwithstanding the challenging environment, include growing sustainable operating profit of the group by 16% to 752 million rand. Sustainable headline earnings per share increased 13% to 553 cents. We sold the main distribution facility of K&N in Singapore, and we relocated the operations to China. From our share of the proceeds, we received the dividends from K&N of 20 million Singapore dollars. On the 8th of July, we redeemed all the 6.9 million outstanding preference shares for a total of 703 million rand. Through this rationalization of our capital structure, we've unlocked additional value for ordinary shareholders. As this redemption took place partway through the year, shareholders will see the full benefit coming through in the future. Throughout the year, we were able to repurchase and cancel 4.9 million ordinary shares for 157 million rand. This happened near the end of the year, thus the full benefit of these repurchases will only be reflected in the upcoming year. During the year, we completed the acquisition of the UK-based Nationwide Bearing Company Limited. We also restructured the KMP operations into the K&N joint venture and sold 3 non-core properties. I will speak more about these later in the presentation. Group financial overview. Sustainable operating profit was 16% higher than the previous year, amounting to 752 million rand. In determining sustainable operating profits, we have made the following adjustments. In both the current and prior year, we reversed profits made on the disposal of non-core properties, as well as the impairments on those properties when they were reclassified as held for sale. We also reversed profits made on the disposal of subsidiaries. We added back a modification loss, which is the time value of money accounting adjustment on amounts owed to the group by the KMP operations. Lastly, in the current year, we added back the amortization of the purchase price allocation assets of 6.9 million rand. In the prior year, we also added back an impairment on an intangible asset and an early termination loss of an interest rate swap instrument. The K&N contribution increased by 10%. In determining our share of sustainable net contribution from K&N, we adjusted the profit made on the disposal of the distribution centre in Singapore, as well as the cost to relocate the distribution facilities to China, which included a retrenchment component. We also adjusted an accounting profit for the derecognition of the right of use assets and liabilities related to the distribution centre. In both the current and prior years, we added back the amortization of the purchase price allocation assets on the various subsidiaries of K&N. In the prior year, we also deducted the profit on the disposal of a property in Shanghai. Sustainable headline earnings increased by 12%. In determining our sustainable headline earnings, we added back a time value of money adjustment on an amount of money owing from KMP to the group, and the amortization of the PPA assets on the NWB investment. As part of the disposal of the K&N warehouse, we adjusted for an accounting profit from the derecognition of the right of use assets and liabilities, as well as the relocation and retrenchment costs associated with the disposal. We also added back the PPA amortization of other subsidiaries in K&N. Please have a look at our key indicators. Where appropriate, they've been adjusted for once-off items to try present a position showing sustainable earnings. Operating profit was 16% higher than the prior year. Headline earnings per share grew by 13% to 553 cents. Our net asset value per share of 59.31 rand was 13% higher than at 31 March 2024. No adjustment has been made to the net asset value calculation. I will now hand over to Nazli.
Revenue for the year increased 6% from the prior year. The gross profit percentage improved slightly to 33%. As a key management initiative, the team worked hard on maintaining this margin. We remained focused on overheads during the year, and management were able to save costs throughout our businesses. Operating profit before foreign exchange movements for the year was 21% higher than the comparative year. This highlights the resilient nature of our operations under tough trading conditions, and we thank our management teams for their ingenuity and focus in growing the business. Comparing the opening and closing rates over the financial year, the rand remained relatively stable. Against the US dollar, the rand appreciated 3%, from 18.93 on the 1st of April to 18.30 on the 31st of March. However, throughout the year, we saw much volatility in the currency, with the rand oscillating as high as 19 rands and as low as 17 rands to the dollar. The impact on our group for this financial year was a net forex loss of 16 million rands, which is a 49 million rand swing compared to the 33 million rand net forex gain in the prior year. As a matter of policy, in South Africa, we hedge all confirmed foreign purchase orders. Net finance costs increased by 13 million rands due to higher net debt. During the period, the South African Reserve Bank decreased the prime interest rate by 75 basis points through a stepped approach to 11%. We welcome these adjustments from the SARB, and we hope to see continued cuts in the future. Ordinary shareholders are better off despite the increased finance costs, given the savings realized on the reduction in payment of dividends to preference shareholders. The redemption of the preference shares took place at the beginning of July, and the full benefit will only be seen in the next financial year. Please take note of the 75 million rand and the 40 million rand foreign exchange loss on foreign operations. This is the impact of having to mark our foreign operations to the spot rate at the end of each financial year and reflects the slight appreciation of the rand over the period. With our offshore expansion strategy, we have made our business more reliant on the major foreign currencies, and we see the impact of this through this forex adjustment. We believe that our strategy is correct and that it will yield benefits over the longer term. Property, plant and equipment decreased by 100 million rands. This is primarily driven by the disposal of the KMP operations to the Keen An joint venture. Investment in joint ventures is our 48.8% investment in Keen An. The increase over the reporting period is made up of 365 million rands of equity accounted earnings, less 46 million rands of foreign currency translation, and dividends declared of 311 million rands. Goodwill decreased by 11 million rands. This is the net impact of the derecognition of the goodwill following the disposal of the KMP business and the recognition of goodwill on the acquisition of NWB, as well as a foreign exchange adjustment from the strengthening of the rand. Finance lease receivables, including the current portion, increased from 214 million rands to 384 million rands. This is finance extended to customers across our CE business. This finance is both short and long-term in nature. We remain focused on working capital management. Inventories net of provisions decreased by 44 million rands. This decrease is driven by the strengthening of the rand and the derecognition of the KMP inventories as part of the disposal. The net reduction in the RPE segment was due to the KMP transaction and the addition of NWB. In RPI, gross inventories increased by 5 million rands. The management team has done well in keeping inventories flat year on year. With the expansion of the RPA segment into Western Europe, we have made further investments into inventory. Our management teams continue to focus on the number of months of inventory held. With the global tariff wars ramping up, we are still experiencing volatility in currencies, logistic costs, and inflationary pressures in our basket of products. Our continued focus on ordering the correct inventory and selling aged inventory has helped to keep this number in check. Trade and other receivables increased by 88 million rands. We continue to see across our businesses that the debtor insurance levels and criteria continue to tighten. We continue to focus on giving appropriate credit and ensuring the collectability of our receivables. Please note our cash on hand of 800 million rands. We are delighted to share that during the year, we successfully redeemed all 6.9 million of the group's outstanding preference shares. This achievement marks a significant milestone as we continue our efforts to enhance value for our shareholders. The redemption has already delivered a net gain to ordinary shareholders over the year and is expected to generate even greater benefits on an annualized basis going forward. Our borrowings and finance lease liabilities amounted to 1.49 billion rands, of which 1.16 billion is non-current and 331 million is current. Of the total borrowings, finance lease liabilities make up 349 million rands. With our cash on hand of 800 million rands and our overdraft of 20 million, we have net cash on hand of 780 million rands. Our net interest-bearing debt is thus 706 million rands. The equivalent number in March 2024 was 483 million rands. This increase of 223 million is mostly explained by the 170 million rand increase in finance lease liabilities in our CE business segment. Please note that the 706 million rand excludes the IFRS 16 liabilities of 253 million. Including IFRS 16, net interest-bearing debt for the year increased by 204 million rands. Our net interest-bearing debt to equity sits at a healthy 18%. Please see a summary of our banking covenants that have all been met at year-end. We were pleased to generate 725 million rand cash from operations, which includes the investment of 170 million in finance leases with customers. We also continued the expansion of the group through the acquisition of NWB in the UK for 190 million rands. The disposal of KMP to the Keenan joint venture and the disposal of other subsidiaries generated a cash inflow of 351 million rands. We received 311 million rands of dividends from Keenan, which included our portion of the proceeds from the disposal of the distribution centre in Singapore. In the year, we returned in excess of 1 billion rands to shareholders. We distributed this by way of dividends to shareholders of 166 million rands, repurchases of 4.9 million ordinary shares in the market for 157 million rands, and we repurchased all of the outstanding preference shares for 703 million. The cash generated not only supported ongoing investments in our operations, but also enabled us to return value to shareholders through dividends and share buybacks. We are pleased with the net closing cash balance of 780 million rands, which is after all of the activities detailed above. I now hand back to Stephen.
Thank you, Nazli. Operational segment review. We report our business as 4 segments, and while Keenan forms part of segment 1, we will report separately on the Keenan business due to its relative size and contribution. Our segments are RPE, Keenan, RPI, RPA, and CE. RPE. This segment includes Keenan, ESP, and the newly acquired NWB, amongst others. We will first report on the other parts businesses in the segment, and Keenan will be reported on separately. Revenue decreased by 48%, This is the net impact of restructuring of the KMP operations into the K&N joint venture, which was replaced by the acquisition of the NWB business. Although its revenue level is lower, we were nearly able to make up the entire operating profit. Operating profit in this segment decreased by 5%. Net operating assets decreased to 351 million rand. The return on net operating assets improved from 30% to 39%. Please see how we determine sustainable operating profits for the purposes of determining our returns. Earthmoving, which includes mining and construction, is 100% of the market in this segment. All our revenue in this segment is from parts. The South African businesses continue to perform well, and ESP continues to identify and supply new customers as it increases its product offerings to meet changing markets. The UK-based NWB acquisition performed well in its first year with the group. Invicta owns 48.8% of the K&N group. These results reflect the full K&N group and not the Invicta ownership interest. These results are presented in Singapore dollars. Revenue was 16% higher than the prior year, primarily due to the inclusion of the KMP operations post the restructure on 1 April, as previously mentioned. Sustainable operating profits increased by 12% to $29 million. Notwithstanding the market conditions, K&N performed well. Specifically in China, we were able to achieve an appropriate gross profit in the KKB manufacturing entity. Net operating assets increased by 8% to $219 million, and our return on net operating assets was 13%. Please see how we determined sustainable operating profits. The adjustments in K&N were a reversal of the profits made on the disposal of the Singapore warehouse and the associated costs related to the relocation of the distribution centre to China, which included some retrenchment costs, and the reversal of the amortization of the purchase price allocation assets. The biggest portion of our revenue in K&N is from resellers. Heavy machinery parts account for 84% of our sales, and automotive parts account for 16% of our sales. K&N continues to serve many different customers and markets across the world. Uncertainty is heightened about the performance of both the US distribution and Chinese manufacturing business with the onset of the US-China tariff wars. We mitigated this by substantially increasing our stock holdings in the United States prior to the presidential inauguration and by expanding our manufacturing capabilities in Japan. The move of the main K&N warehouse from Singapore to China has also been completed, and the operations are expected to settle down in the first half of this financial year. Overall, our K&N business has sufficient inventory to manage the current levels of business activities, whilst the teams become familiar with the new operating structure. RPI consists of 5 businesses and includes BMG. Revenue for RPI was 3% higher than the prior year. Sustainable operating profit improved by 16%. This improvement was due to management's ability to contain costs across our businesses. With net operating assets increasing by only 3 million rand, this has improved our return on net operating assets to 20%. Please see how we determine sustainable operating profits for the purpose of determining our returns. Mining continues to be the biggest industry served by RPI, accounting for 20% of revenue. Other than mining, we continue to serve a diverse range of customers. The teams have done well this year in diversifying the markets we serve. Consumable parts amount to 57% of sales, and engineering, which includes value added to products, amounts to 43% of sales. Our businesses in Africa make up 19% of the segment. Following the outcome of the South African election, we saw South African industrial activities improve. We hope that the GNU will focus on larger infrastructure projects in the medium term to help stimulate growth in the sector. The project business outlook and order book remain strong. Cash extraction from our African operations remains challenging, stemming from a lack of local liquidity in the market. RPA. This segment includes our UPG business located in both South Africa, UK and Europe. Revenue for the RPA segment was 10% higher than the prior year. The growth in revenue is mainly due to the contribution from the IMEX Part acquisition being fully included in the current year compared to only 9 months in the prior year. Sustainable operating profit was largely flat at 3% lower than the prior year. Net assets increased by 14 million. Our return on net operating assets has decreased slightly from 18 to 17%. Please see how we determine sustainable operating profits for the purposes of determining our return. Automotive and transport are the biggest industries we serve in RPA at 80% of revenue, with agriculture also growing into an important sector, now at 12%. Consumables amounted to 98% of revenue, and engineering, which includes value added to products, amounted to 2% of revenue. Our businesses in Europe and the UK make up 64% of the segment, with the businesses in South Africa making up the balance. We have expanded our house brand product range to serve the price-sensitive South African market, where the current conditions are particularly tough. While the war in Ukraine continues to impact our business there, the team have done well to carve out a place for us in the market. We've expanded our RPA business into Western Europe and are seeing promising opportunities for growth in this market. The CE segment consists of 4 businesses, 2 being construction and mining related and 2 being material handling businesses. Revenue for the CE segment was 11% higher than the prior year. Sustainable operating profit was flat at 107 million rand. This is due to margin pressures that the business experienced in the local market due to an oversupply of products amongst competitors. We believe that the oversupply resulted from caution in ordering from our customers, stemming from uncertainty around the South African elections. With the election behind us, we have seen demand normalize, and we believe that we have come to the end of the oversupply in the market. Our return on net operating assets was marginally improved from 26% to 27%. Please see how we determine sustainable operating profits for the purposes of determining our return. Earthmoving, which includes products for the mining and construction sectors, accounted for 78% of revenue, and the balance is from material handling at 22%. While parts, service and rentals only account for 25% of revenue, we can cover 75% of the cost of our CE operation based on these revenue streams. As customers extend the lives of the capital equipment, our parts businesses continue to do well in servicing these machines. We are seeing many new market entrances come to South Africa, which is putting pressure on margins. However, our in-house financing options and leading brands make us an attractive option for customers. Key developments and transactions. A core element of our strategy is to reduce leverage on the balance sheet. During this year, we successfully redeemed our preference shares from our capital structure without the need to issue additional ordinary shares. Removing the preference shares was essential, as it freed up more cash for ordinary dividends. Previously, dividends paid to preference shareholders were deducted from earnings before calculating dividends for ordinary shareholders. Over time, ordinary shareholders will fully benefit from this improved position. On 1 April 2024, we acquired 100% of Nationwide Bearing Company Limited. NWB was founded in 1992 and is a UK-based supplier of consumable parts to the earth-moving and agricultural machinery aftermarkets. Their product offerings includes items such as bearings, belts, bushers and seals. NWB has its own proprietary in-house developed brand, NWB. We paid £12.4 million for the NWB business, which had roughly £4 million of cash on the balance sheet at the time of acquisition. Additionally, the business was able to generate sufficient cash to meet both deferred payments to the seller in September and March of £1.2 million each. We thus outlaid £6.7 million, and NWB provided earnings of roughly £1.5 million for the year, an effective yield in pounds in excess of 20%. Also, on 1 April, we completed the disposal of the KMP Group to our joint venture, Keenan, based in Singapore. We believe that by merging KMP and the Keenan Group businesses will create a strategic focus on industries and markets where Invicta has extensive experience and strong management expertise, complemented by Keenan's robust procurement, network and manufacturing capabilities. A portion of the cash proceeds from this transaction were used to settle our offshore debt facilities. We have disposed of our Keenan warehouse in Singapore for $63 million. From these proceeds, we received a dividend of $20 million, which was applied against debt facilities in South Africa to reduce the overall debt position of the group. As part of the disposal of this property, Keenan has moved its primary distribution facility to Shanghai, from where it will continue to service all of its customers. Keenan will maintain a head office presence in Singapore, from where the Keenan executive and sales teams will operate. With the main distribution centre located in Shanghai, we anticipate that the profitability of the Keenan operations can be improved. Also, speaking to our customers across Asia, most of them supported the move as they feel they can be better serviced out of Shanghai. We were pleased to be able to repurchase 4.9 million ordinary shares in the market in the year, which enabled us to return a further 157 million rand to shareholders. Following the year end in April, we were further able to repurchase roughly 3.1 million shares in the market, thereby returning a further 97 million rand to shareholders. Prospects and strategy. We aim to grow a diversified, sustainable replacement parts group, providing above-market returns to stakeholders. We constantly review and restructure our existing businesses to ensure they achieve the desired returns. We aim to have a geographical and sectorial diverse group within the next year. Our objectives over this period would include managing working capital and optimizing operations, generating cash, managing the supply chain and logistical challenges, looking for appropriate acquisitions and for new product lines for our existing businesses. With the implementation of the tariff wars globally, future economic outlook remains tough to gauge as reciprocal tariffs fluctuate. We are working hard to remain well informed on the developments and hope to move as quickly as possible to assess and deal with developments promptly to ensure the businesses remain stable. The latest development in the Israel-Iran war will significantly impact global logistics. The conflict has raised fears of insecurity in the Straits of Hormuz. Any disruption here could sharply increase freight costs, delay shipping times, and cause fuel prices to surge. With so much uncertainty in the world, we will continue to focus on cash generation. Having a relatively debt-free business gives us the necessary time to respond to difficult situations and at the same time provides the capacity for us to implement our acquisition strategy. We are evaluating several opportunities on the acquisition front, and should these global headwinds subside and we can identify suitable targets that align with our strategy, we will certainly continue to acquire businesses. As a result of our relative financial strength, we will endeavour to return to shareholders approximately 30% of our earnings annually, be it either through buybacks in the market or dividends. Many of the sectors we serve are trading in line with these results, and we continue to service our clients without stockouts and delay. Accordingly, we remain cautiously optimistic about the new year. We're extremely grateful that we've delivered strong performance to our shareholders and other stakeholders. Thank you to our loyal suppliers, customers and advisors for your continued partnership with the group. Our experienced, diligent and dedicated teams, from the factory floors to the boardrooms, we thank you all for your efforts over this year. Lastly, we wish to thank our chairman and the non-executives for their guidance and advice.